All right, let's dive right into this explainer. Today we're unpacking a really fascinating tug-of-war going on with MaxLinear. You know the drill. The market is totally obsessed with any company making an AI pivot right now, and MaxLinear is sitting right square in the crosshairs of all that hype. But as we're going to see, behind those glossy product announcements, there's a seriously complex financial reality that we need to dig into.
Check this out, 9.1%. What's so wild about this number is that it was a sudden, massive jump in MaxLinear's stock price right after a huge product announcement. According to Quiver Quantitative, investors absolutely love the news, sending the shares up over 9% in just a single day. So what exactly triggered this massive burst of enthusiasm?
Well, to get why the market reacted like that, we got to look at who MaxLinear actually is. They're a fabless IC design company. Historically, you've probably known them for broadband and networking stuff. But right now, they are making a hard, incredibly deliberate pivot straight into the AI data center infrastructure space. They want a slice of that massive AI pie. And believe me, Wall Street is watching like a hawk to see if they can actually pull this off.
Here's the roadmap for today's explainer. We'll start with the AI infrastructure catalyst, then break down their Q1 earnings, untangle the balance sheet complexities, look at some crazy insider moves versus institutional buying, and finally, get Wall Street's verdict.
All right, kicking things off with Section 1, the AI infrastructure catalyst powering data centers.
This right here brilliantly illustrates exactly why investors are so hyped. MaxLinear just dropped these new USB to UART solutions. They're calling them Coronado and Laguna. These are tailor-made for the control plane connectivity needs inside AI data centers. But the real confidence booster? The timeline. They've explicitly stated Coronado will be sampling by June 2026, hitting full production in the second half of that year. Add in the recent rollout of their Trinity wireless backhaul platform for 5G, and you've got this steady, very convincing drumbeat of infrastructure products hitting the market.
Okay, moving on to Section 2, Q1 earnings breakdown, growth versus margins.
But to know if all that product type is actually justified, we've got to look under the hood. The crucial thing to spot here is their liquidity. Their earnings deck shows they're sitting on $61.1 million in cash against over $770 million in total assets. Now, context is absolutely key here. That cash pile is actually down from $72.8 million at the end of 2025. So what does that tell us? It means as they sprint forward with this AI pivot, they are burning through cash pretty aggressively to fund it all.
Now, on the surface, the income statement looks, relatively stable. They pulled in a non-GAAP net income of $19.4 million, which shakes out to an EPS of 22 cents. Not bad, right? Well, hold on. There is a massive catch when it comes to their gross margins, and to spot it, we really have to listen to the whisperings on their earnings calls.
So, during the Q1 call, an analyst actually pointed out something super interesting. MaxLinear had a 30% jump in their higher margin infrastructure mix, but their overall gross margins? Totally flat. How does that happen? Well, CFO Stephen Litchfield said the quiet part out loud right here. Quote, input costs are rising, wafer cost, packaging, moving up. The literal, real-world costs of building these chips are surging, and it's eating their anticipated profits alive. So even with a much better product mix, the brutal macroeconomic reality of supply chain pricing is acting as a massive headwind right now.
Which brings us to Section 3, balance sheet and complexities, reading the fine print.
Remember those seemingly solid non-GAAP profit numbers we literally just looked at? Well, it is absolutely vital to realize that those reported profits completely ignore the mountain of stock they're giving out to employees. In their 10K, MaxLinear flat out calls stock-based compensation a significant recurring expense. Look, they are fighting tooth and nail to keep top-tier engineering talent, so they have to hand out a ton of stock. But as an investor, you have to know this because all that extra stock directly dilutes the value of your shares.
You're also going to run into some seriously dense, sleep-inducing terms in their 8K filings, like permitted call spread agreements. Without dragging you through a finance degree, here's what that actually means. MaxLinear is using highly complex derivative transactions just to stop their stock from getting completely watered down by convertible debt. Why should you care? Because it basically shows a management team doing financial gymnastics to manage a very delicate balance sheet, all while trying to fund a crazy expensive market transition. And honestly, their 10K filing brings a surprisingly human element into all this math. They candidly admit to some pretty glaring risk factors. For one, they openly state that recent layoffs could be seriously hurting employee morale. Plus, they admit that keeping their best engineers is just getting harder and much more expensive.
If they can't attract and retain that elite technical talent, this entire AI data center strategy, it could just stall out before it even leaves the launchpad.
All right, shifting gears to Section 4, Insider Moves and Institutions, the Tug of War.
This is where things get wild. We've got an absolute tug-of-war happening right in front of us. On one side, company insiders have not bought a single share on the open market in 6 months. 0. Instead, we've seen 11 insider sales. The CFO unloaded nearly $750,000 in stock, and Director Albert Moyer dumped $1.2 million worth. But then, on the exact opposite side, giant institutional hedge funds are practically backing up the truck. Invesco exploded their position by over 400%, grabbing 1.7 million shares, while SOAR investors scooped up over 840,000. So the guys running the company are cashing out, while the massive Wall Street funds are buying in hand over fist.
Let's see what the pros think in Section 5, Wall Street's Verdict, Forecasts and Targets.
So who's right here? The executives taking their chips off the table or the hedge funds doubling down? Well, Wall Street analysts are actually leaning surprisingly bullish. A lot of this optimism is riding on a frankly staggering consensus forecast, nearly 42% revenue growth for 2026, which would push revenues to an estimated $663.5 million. These analysts are basically betting the house that those new Coronado and Laguna AI products are going to be massive hits that completely scale the company's top line over the next couple of years.
But hey, don't mistake that broad growth forecast for total agreement. Just look at the ridiculous spread among these individual analysts. Loop Capital threw an incredibly optimistic $75 price target on the stock, while Wells Fargo is sitting all the way down in the basement at a super pessimistic $20. It is incredibly rare to see this wide of a spread among the major players, and it perfectly captures just how much uncertainty is swirling around the stock.
At the end of the day, you've got to weigh the evidence from these SEC filings and analyst forecasts for yourself. The big question is clear. Will the massive potential of these new AI data center products be enough to overpower surging wafer costs, all that complex financial engineering, and the flashing red warning signs of executives selling off their own shares? That's the ultimate puzzle with MaxLinear, and it's exactly what the market is trying to figure out every single day. Thanks for joining me on this explainer, and I'll catch you on the next one.